XLFI looks like a simple monthly income ETF, but under the hood it is basically XLF wearing a cash flow costume. It owns the financial sector, sells call options around that exposure, and sends investors monthly checks. Nice. But the autopsy question is sharper. Is this fund creating income or just converting future upside into today's payout? Today we're dissecting the Financial Select Sector SBDR Premium Income ETF, ticker XLFI, from State Street. This is not a mystery box full of exotic bank trades. The core machine is pretty clean. XLFI is an actively managed fund of funds based on the S&P Financial Select Sector Index, and it gets that exposure by investing in XLF, the Financial Select Sector SBDR fund. So the base layer is U.S. financial stocks through XLF, banks, insurers, asset managers, exchanges, and the general financial sector ecosystem. Then XLFI adds the income engine. It sells short-dated call options tied to that same financial sector exposure. Plain English, it owns the financial sector basket, then rents out some upside to option buyers in exchange for cash premium. That premium helps fund the monthly distribution. The catch is that if financials rip higher, XLFI may not fully participate. This is income with a ceiling attached. Quick but important reality check. This video is for research and education only. It is not financial, investment, tax, or legal advice, and it is not a recommendation to buy, sell, or hold XLFI or any other security. ETFs can lose value, distributions can change, and high-yield strategies can have trade-offs that do not show up in a simple yield screenshot. Before making any decision, verify the current fund documents, prospectus, holdings, distribution notices, tax information, and issuer materials for yourself. And if this touches your portfolio, taxes, legal situation, retirement plan, or income needs, consult a qualified professional who can evaluate your specific circumstances. Around here, we like income. We like due diligence more. Here is the snapshot as of June 26, 2026. XLFI's latest price and net asset value are $23.25. Assets under management are $6 million, so this is still a very small fund. The expense ratio is 0.35%, and the fund pays monthly. Its category is derivative income, which is exactly what it sounds like. Equity exposure plus an options overlay designed to manufacture distributable cash. The holdings page gives away the plot. XLFI holds XLF at 100%. It also has a small position in the State Street U.S. government money market portfolio at 0.25%. Then you see the call options. A listed 54 call at negative 0.10% and a listed 56 call at negative 0.18%. Negative weights are the tell. Those are written calls, not calls the fund owns, so XLFI is not just financials with yield. It is XLF plus a short call program, now the number that gets everybody leaning forward. The headline distribution yield is 11%. That is the billboard. But the mechanical annualized figure based on the latest payment is 8%. That difference matters, because it tells you the payout level is not a fixed coupon carved into stone. The latest distribution was 16 cents per share. With a fund like this, yield is not magic dust sprinkled on a sector ETF. The payout can come from option premium, dividends from the underlying exposure, and potentially return of capital. Return of capital is not automatically bad, but it is not free money either. Sometimes it means the fund is handing you back part of the economic value that used to live inside the share price. So when you see 11%, do not stop there. Ask the better question. What did the fund sell, trade, or give up to create that cash? In XLFI's case, the answer is financial sector upside and option premium. The distribution history is already telling a story. The first 4 average payout was 29 cents per share. The latest 4 average is 24 cents. The latest distribution was 16 cents. The stated trend is down from the initial launch period payouts to the latest 4 paid rows. That does not mean XLFI is broken. It means the early checks should not be treated as a permanent salary. Options income is variable because option premium is variable. It depends on volatility, market direction, the price level of the underlying exposure, and how the manager chooses to sell calls. If conditions are generous, the machine can collect more premium. If conditions cool off, the cash harvest can shrink. This is one of the classic traps in high-yield ETFs. Investors see launch period payouts, annualize them in their heads, and accidentally build a fantasy budget. XLFI pays monthly, yes, but monthly does not mean stable. The trend says this income stream should be treated as flexible, not contractual. Now let's look at the part of the autopsy that does not fit nicely on a yield graphic, the price and net asset value path. XLFI launched with a reference price of $24.69. As of June 26, 2026, NAV is $23.25. Since inception, the NAV return is negative 6%. The maximum drawdown is negative 14%. That is not a side note. That is the engine where XLFI owns financial sector equity exposure through XLF, so it can fall when financials fall. But it also sells calls, which means some upside can be capped when the sector rallies. Add in large cash distributions, including the possibility of return of capital, and you can get a fund that pays you regularly, while the share value drifts lower. This is why NAV matters so much in income funds. The monthly check is the smoke coming out of the machine. NAV is the machine. Now, to be fair, the cash distributions have done real work. Since launch, XLFI has paid $2.50 per share in cash distributions. When you include those distributions, the simple distribution inclusive return since inception is 4%. That is a very different picture from looking only at the negative 6% NAV return. This is why income ETFs need two scoreboards. Scoreboard 1 asks, what happened to the fund's value? Scoreboard 2 asks, what happened after including the cash paid along the way? For XLFI, the cash has more than offset the NAV decline so far on a simple distribution inclusive basis. But there is still a lesson hiding inside that positive 4%. The return has depended heavily on distributions, not on the fund growing its share value. That can be perfectly acceptable if your goal is current income and you understand the trade. It becomes dangerous only when investors confuse high payout with high-quality total return. They are related, but they are not the same thing. Let's open the hood all the way. XLFI's main holding is XLF, the Financial Select Sector SPDR Fund. XLF is the vehicle that gives XLFI exposure to the S&P Financial Select Sector. So before this is an income product, it is a financial sector equity product. If financials struggle, XLFI feels that. If financials rise, XLFI benefits but with a twist. The twist is the short-dated call overlay. XLFI sells call options tied to the financial sector exposure. A call option gives another investor the right to participate above a certain level for a certain period. XLFI collects premium for selling that right. That premium is the raw material for the monthly payout. The trade-off is brutally simple. In flat or choppy markets, selling calls can feel smart because the fund collects premium while the sector goes nowhere. In strong rallies, the sold calls can cap upside. If you are evaluating XLFI, here is the checklist. First, do you actually want financial sector exposure? The wrapper is income-focused, but the core exposure is still XLF and the S&P Financial Select Sector. If you do not want that sector in your portfolio, the yield does not magically solve the problem. Second, are you comfortable trading upside for income? Short-dated call selling can generate premium, but it can also cap gains. Third, can your income plan handle variable payouts? The first 4 average was 29 cents, the latest 4 average is 24 cents, and the latest distribution was 16 cents. Fourth, watch the fund size. AUM is $6 million, which is small. Fifth, compare yield definitions. Headline yield is 11%, while the latest payment annualized number is 8%. Sixth, track NAV like a hawk. The launch reference price was $24.69, current NAV is $23.25, and NAV return since inception is negative 6%. The checks matter. The engine matters more. Bottom line, XLFI is not a free income machine. It is XLF plus a call selling overlay. It owns financial sector exposure through the Financial Select Sector SPDR Fund, sells short-dated calls around that exposure, collects premium, and uses that machinery to support monthly distributions. The appeal is obvious. Monthly income, an 11% headline yield, and a familiar State Street financial sector wrapper. The trade-off is also obvious if you look closely. Variable payouts, capped upside, small fund size, and NAV pressure since launch. The simple distribution-inclusive return since inception is 4%, so the cash has mattered. But the NAV path says the fund has not been compounding cleanly under the surface. So the autopsy verdict is this: XLFI can make sense only if you want financial sector exposure and prefer current cash flow over full upside participation. If you just saw 11% and thought you found a cheat code, slow down. This fund does not create income from nowhere.